Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name's Manpreet and welcome to Through the Noise. Now, what a week it's been in markets. We had some fairly dramatic moves, particularly around the weekend as markets started to find new reasons to worry about both the US growth outlook as well as what seemed to be fairly excessive positioning around FX carry trades and the US technology sector equities. Now, the calm after the storm seems almost equally dramatic. So the big question is, where do we go from here? Should investors worry more, or is it time to start looking for opportunities amidst the volatility? So to discuss these questions and more, today I'm joined by Raymond Cheng, our Chief Investment Officer for North Asia. So welcome, Raymond. Thanks for joining us. It's quite timely to have you, of course, on this podcast. Let's start with the volatility. Can you help our listeners understand what triggered the big shakeout and what you see as the big investment implications?
Sure, Manpreet. We see three major drivers behind this shakeout. One, concerns about a slowing U.S. job market. Two, doubts about near-term benefits of AI investments amidst crowded investor positioning in the tech names. And three, tightening monetary policy in Japan. Let's start off with the first factor here, the slowing U.S. job market. The U.S. monthly job creation number slowed sharply, right? For the month of July, it declined to 114,000 from 179,000 in June. Unemployment rate also rose to 4.3%. As a result, some U.S. recession indicators we closely follow have been triggered. Nonetheless, an unusual rise in labor supply in this cycle due to a surge in immigration could distort the signal. Also, a closely followed U.S. service sector business confidence indicator surprisingly strengthened in the month of July, which should alleviate some of the growth concerns. Now, we will need to watch carefully high-frequency job indicators going forward, such as weekly jobless claims. Of course, a weaker job market would likely hurt consumption going forward, which has been the key U.S. growth driver. Now, as for the second factor, which is the U.S. tech sector, doubts about the near-term benefits of AI investments have grown during the recent earnings season. It happened at a time when investor positioning in the sector has been very crowded, a risk we flagged in the weekly market view 3 weeks ago. The mitigating factor is that the U.S. earnings outlook remains quite robust, with almost 80% of the S&P 500 companies beating Q2 earnings estimates. Consensus now expects 10.5% earnings growth this year and 14.8% growth next year. So the third factor, tightening Bank of Japan monetary policy, which is a quite a drastic turn from the ultra loose policy in recent years, against the backdrop of surging policy rates in major economies, which had led investors to borrow low-cost yen to build leverage positions in cyclical assets. Now, the BOJ surprise rate hike last week, plus plans to halve bond purchases by Q2 of 2026, jolted the currency market. At one point, the dollar-yen plunged over 12% from the mid-July level. The dollar-yen and another favorite borrowing currency, Swiss franc, are now likely to consolidate. Now, while this points to some upside for the pairs in the near term, gains are likely to be capped amidst U.S. growth concerns. So in terms of investment implications from here on, the return of negative correlation between stocks and bonds meant our recommended balanced asset allocation strategy has been relatively resilient. Essentially, gains in bonds have offset losses in equities, highlighting the benefits of a diversified foundation allocation when U.S. growth weakens. The U.S. 10-year government bond yield has also bounced off last year's low, just below 3.8% as markets consolidate. Yields around 4% should offer a good opportunity for those who are still holding cash to lock in some yields from high-quality bonds for a longer period. The bonds are also likely to benefit from the Fed going to cut rates to support growth as well. In terms of equities, we see selective opportunities. The market dislocation has made U.S. tech and communication services equities attractive again. The earnings growth expectations and corporate balance sheets for those two sectors remain robust. there's also an opportunity to add to some defensive equity exposures as well.
Thanks, Raymond, for that detailed summary. I wanted to build a little more on the investment implications. So, one area which stood out in the shakeout last week was bond yields, which slumped notably. For investors still looking to lock in yields, do you believe there's still time to add to bonds?
Yeah, U.S. government bond yields fell sharply in the beginning of the week, right? With the 10-year yield down from 4% to as low as 3.6% on growth fear, which brought about a spike in Fed rate cut expectations, as well as demand for safe haven assets, including U.S. government bonds. So now bullish positioning on U.S. government bonds looks increasingly stretched, with positioning in the 10-year bonds reaching an all-time high on Monday. As a result, markets are now pricing about 180 basis points of Fed rate cuts over the next 12 months, which looks quite aggressive. Together, these data points suggest U.S. bond yields are at risk of a consolidation in the near term. Now, as yields consolidate, we see opportunities to add to bonds. As the 10-year yield climbs back, now closer to 4%, this offers an opportunity to lock in yields. The shorter term yields have fallen more than the longer term so far this month, which makes it attractive to lock in yields for a longer horizon. History shows a Fed rate cutting cycle coincides with falling long-term bond yields. Falling long-term bond yields will also suggest rising prices for the long-term bonds. Now, we also observe an increase in the risk premium for most corporate and emerging market bonds. For instance, the yield premium on our preferred emerging market US dollar government bonds rose by more than 10 basis points this week, which enhances its valuation appeal relative to history.
Okay, so maybe that's on bonds, but moving to equities as well, we also had a sell-off in equities to varying degrees around the world. Where do you see the key opportunities to potentially bottom fish?
Yeah. Despite the volatility, we expect US equities to outperform global equities over the next 6 to 12 months. As the Fed has much ammunition for rate cuts, we believe investors' focus will shift back to US equities fundamental outlook. Now, if we focus on the Q2 earnings season, we witnessed 86% of the S&P 500 companies have already reported earnings, 78% of which beat earnings expectations, according to IBES. The expectations for this year's earnings growth have modestly ticked down from 10.7% to still a solid 10.5%, whereas next year's earnings growth forecast has ticked up to 14.8% from 14.4% compared with the start of the earnings season. Now, our preferred US sectors continue to be communication services and technology. Now, we suggest balancing these growth exposures with defensive exposures. Now, some quality defensive exposures would include Euro area healthcare sector and the high dividend Chinese state-owned enterprises X shares traded in Hong Kong. Now, we also tactically recommend adding to US major banks after the pullback because financials deliver one of the most positive Q2 earnings surprises. And going forward, banks should also benefit from yield curve steepening as well. Now, in summary, we suggest using the opportunity to diversify our investment portfolio across sectors and markets to make it more resilient against any unexpected risk and volatility.
Thanks, Raymond. And finally, on currency markets, the yen and the Swiss franc bore the brunt of the reversal in the carry trade. Do you see these safe haven currencies as being overbought today?
Safe haven currencies have indeed strengthened quite notably in recent days, right? On rising concerns of slower than expected US growth and the unwinding of carry trades to use low yielding currencies as sources of funding. However, we believe momentum of this move is fading. Technically, both the dollar yen and dollar Swiss franc are oversold. We expect a moderate near-term rebound over the coming weeks. Resistance for the dollar yen is at 151.8. US producer prices and inflation prints would be the next key catalysts. It would likely take a further unexpected cooling in both prints to cause the dollar yen to test the next support level at 140.2. Now, we see the dollar Swiss franc face strong resistance at 0.873. The upcoming Swiss National Bank meeting in late September is the next focus to us. An unexpected acceleration of Fed rate cuts would raise risks of the pair testing support level at 0.833 after a technical rebound.
All right. I think that sort of brings us to the end of the amount of time we have available today. So thank you, Raymond, for taking the time to join us and our listeners today. If I can just sort of summarize the key takeaways, I think number one, of course, bond yields clearly moved sharply lower in the shakeout, but of course, we look to use any rebounds, particularly 10-year moving back towards 4% as opportunities to lock in yields for longer. That's one. Second, of course, equity markets potentially offering opportunities after the sell-off in the US, perhaps more in technology and communication services, but more defensive opportunities, of course, in Euro area and China from a sector perspective. And finally, carry trade currencies, the yen and the Swiss franc. Some room for some consolidation in the near time, but watch out for the natural caps on that consolidation. So thank you very much, listeners, for joining us today. We hope you found it interesting and useful after the volatility that we experienced. Wish you a good weekend ahead, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.